How's it going, everyone? Matt Diamond with Kalshi, and today we're going to be talking about one of the most important Greeks when it comes to options. We're going to be discussing theta, and theta is the rate of decline in the value of an option due to the passage of time, because typically, over time, option values decline. It can also be referred to as time decay of an option. This means an option loses value as time moves closer to its maturity or its expiration date. And that's assuming that everything else remains constant. There's no major fluctuations in the stock price or elevated volatility. And to try to keep it pretty simple, think of it as the amount by which an option's value declines every single day. And you can easily find that on the back end of a broker on the options chain, which I'll do so in this video. And the reason we're going to be talking about theta is because when trading options, it's one of the most important things to factor in, and a lot of people don't do that. They step into the financial markets trading or investing, and they trade the short-dated options, which have become very popular recently, and theta can have a huge effect on what happens with those options. Even if you're correct on the fact that a stock is going to go up and you buy a short-dated call options, theta can really depreciate the value of that call, and even though the stock has moved in your favor, there is still a chance that you lose money on that trade or you don't make anything. And this makes options trading very difficult, but when you compare it to trading event contracts on Kalshi, the really cool thing with that is that it doesn't have theta or time decay, so you don't have to worry about that issue. So now let's go over some examples on individual stocks. This is Meta, and right now it's trading at around $314 on the daily chart. Let's just say that you believe the stock was going to go up, and I'm going to take a guess that maybe this can get to $320, just because I'm taking a guess. At the end of the day, nobody knows what's going to happen. We're all just trying to use the information we have at hand to come up with an educated guess. So as far as factoring in the 320 call and how much value it will lose daily, what we're going to do is go in the back end on the option chain and look at the theta. So if at the top of this, I click on trade and I go into the option chain, so I have two separate options open. I have the August 11th and the August 25th. Two different expiration dates, one closer in expiration than the other. The reason why I'm going to do this is to show that there is a difference in the theta. So going back to what I said, I mentioned that I believe that Meta is going to go to $320. So what we do is we look at the calls, because a call option means we believe that the stock price could potentially go higher. And if we look to the very far left, this column, look at the very top, theta. So if we see the minus 39 cents, this is how much the option is going to lose each day, assuming all other factors remain the same. So you can see that that's a good amount to lose per day if for some reason things trade sideways and you do not get a fast move to the upside on Meta. And this is going to be the short dated call. So the closer to expiration you are, the higher that theta is going to be. So let's go look at another example. Looking at the August 25th expiration calls, a little farther out. Like I mentioned before, I believe that Meta may go to $320. So we look at the $320 strike. We see that the call is a little bit more expensive, 770 by 785. And if we look to the far left, the theta is minus 25 cents versus what the 320 call that expired on the 11th is, which is minus 39 cents. So the theta is going to be lower. And the reason why the theta is lower on farther out expiration dates is because there is more time for that stock price to move until it expires. So the 320 August 25th calls are going to lose 25 cents per day, assuming all other factors remain the same. And this is why trading options can be very tricky, because you have time working against you. They're essentially a depreciating asset if all other factors remain the same. So you have to have substantial moves in your favor in order to make money. Now let's go through one more example just so that way we can make it very clear. This is the daily chart of Google. So let's say that I believe Google is going to go higher. Right now it's trading around $128.50. I believe that it could get to $130. So we're going to go back into the options chain. I'm going to click on trade, and we're looking at the August 11th versus the August 25th, similar to Meta. So we're going to look at a couple different expiration dates, one that's closer and one that's a little farther out. So I said that I believe that Google has the possibility of going to 130. That's just my guess based on all the other factors that I've considered. And if we look at the call options, which means that Google is going to possibly go up, we believe a stock is going to go up. That's what a call is for. They're trading at $1.38 by $1.42. And if you look at the theta to the left here in this column, it's going to be minus 13 cents per day. So assuming all other factors remain the same, this call option is going to lose 13 cents per day. And then if we compare that to August 25th, a strike price that expires a little bit farther out, we're going to look at the 130 calls. They're a little bit more expensive, $2.35 by $3.40. And the theta is minus 9 cents per day. So assuming all other factors remain the same, this option is going to lose 9 cents per day. And once again, this is why trading options can be very difficult, because even if you get the direction right on the stock, if it doesn't happen quick enough, that theta is going to decrease the value of that option. And even though that stock went up and you guessed that it was going to go up, there is the chance that you may not make anything on that trade. And this is one major reason why so many new traders that step into the financial markets and decide to trade options can have a bad experience, because they are unaware of this Greek. And even though that they are potentially right on the direction that a stock is going to go, their P&L says otherwise, and they're losing money. So with everything I just said, you can look at it as a negative thing and think that it's incredibly difficult to figure out how to make money trading options, or you can look at some other ways to get involved in the financial markets, and Kalshi is one of them, because you do not have theta and time decay to worry about when trading event contracts. What you're doing is trading the yes or no contracts on the specific event that you're interested in, and there are no Greeks attached to that. So let's just go check one out. Look at the S&P 500 yearly close. And as you can see, here are some of the contracts. So depending on what you believe the S&P is going to do, we have a couple different zones here, 4,500 to 4,700, 4,700 to 4,900, and 4,900 to 5,100. And there are simple yes and no contracts, and it tells you the price. So at the end of the day, based on the thesis of what you believe is going to happen, you're going to be trading either the yes contract or the no contract, and it's as simple as that. It either happens or it does not. And depending on how many contracts you decide to trade, you can put it over here, and if you decide to trade 10 as an example, it tells you the cost and it tells you the max profit. So you have all the information you need as far as the cost goes and how much you could potentially make on the trade, and you don't have to worry about Greeks eating into any of that profit, because being that it's a yes or no contract you're trading, it's as simple as that. And if you happen to be right on your trade, you know how much you're going to make. And if you're wrong, you know how much you're going to lose. It's all provided to you, and you don't have to worry about any other factors that could dictate that outcome, which is the opposite when trading options, because of all those Greeks involved. Even if you're right on your thesis, your outcome and your P&L could say otherwise. And that is just one of many advantages with trading event contracts on Kalshi versus other financial products. So that was the video. I appreciate you watching. Feel free to like, comment, and subscribe, and I'll see you in the next one.